Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Friday, the 3rd of January, 2025. Happy New Year. I'm Daniel Lam, your host for the podcast. Yes, for the keen long-term listeners, you have spotted it. It is very rare for us to have cut to the chase on Fridays, but that was what I promised in my last podcast. Yesterday was a heartbreaking one because I was leading amongst the local players in the Hong Kong International Chess Open, only to lose unexpectedly in the final round and got overtaken. When I switched on my iPhone after losing the final game, I saw weaknesses in the Hong Kong and China equities. Hang Seng Index broke below the key 20,000 level on the first day of trading with good volume, and dollar CNH was around the 7.35 mark, along with weaknesses in Asian currencies. Like we discussed in the last podcast, Trump's inauguration and further clarity on his policies are key to watch. The ordering of his policies is very important. So what has been powering US equities ahead in the last quarter is Trump's deregulation and tax cuts agenda. However, if Trump's rhetorics about tariffs and immigration control were to take dominance at the very beginning of his second presidential term, more than what the markets would be expecting, then this can cause volatility and raise concerns about Trump's ability to pursue non-inflationary growth. Now, for emerging market equities, such as Hong Kong China equities, it's quite likely that investors would be taking a cautious tone at the beginning of the year until further clarity emerges. For US equities, yes, there's also been correction in the second half of December, but we believe that's likely to provide long-term opportunities for investors. For S&P 500, 5,700 seems to be a good add level and interesting technical support. With overweight US equities for 2025, the mix of Fed cuts and Trump-supportive policies is likely to help US growth to outperform. So this, we believe, will translate into superior earnings growth. Technology and communication services sectors remain our opportunistic ideas. Now, short-term investor positioning may be a risk, but our 3-month technical model stays bullish. So on balance, we believe that this will result in US equity outperformance relative to global equities, despite the headwind of current starting valuations. This is all from me for today. As always, if you enjoyed this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.